Today we are joined by Dr. Monte Vandeveer. He joined the KSU Extension Farm Management Team in February of 2016 as the Southwest Area Extension Agricultural Economist based in Garden City, Kansas, and that's where he joins us from today. On a farm in South Central Kansas with wheat and cow-calf enterprises. Monte received his BS and MS degrees in agricultural economics from K-State University. So he's a native cat. We're glad to have him. And he also got his PhD in agricultural economics from Purdue University. Besides working for K-State Research and Extension, he also has experience working with the USDA Economic Research Service, the University of Nebraska Lincoln's Extension Service, and volunteer service in Vietnam. So very well-rounded. He has a special interest in risk management, particularly crop insurance. Today, he's going to be talking a little bit about his work and his knowledge of the USDA risk management agencies, Pasture, Rangeland, and Forage Insurance. Performed significant amounts of work researching these. Like I said, he's won 3 RMA grants for his work. Today, he's joining us after speaking at the Ag Lenders Conference. He's also a regular contributor to K-State Ag Econ's agmanager.info. If you've not been to agmanager.info, I would highly recommend you check out that website. You may be viewing this webinar from that website as we speak right now. He's going to be sharing with us about Pasture, Rangeland, and Forage Insurance. Really glad to have Dr. Vandeveer with us. And without further ado, I'll let you get started and share your screen.
Thank you, Anthony, for giving me a chance to talk to everybody. I hope our attendees can enjoy the webinar and everybody else who gets to view it online later, too. The Pasture, Rangeland, and Forage Insurance is a relatively new crop insurance product that's been available in the U.S. for several years now, but it's still fairly new to most of our producers. So we're going to spend some time talking about that today, and hopefully it's a benefit to our producers and our Farm Management Association economists. Here's a little bit of background. PRF is a product of the Risk Management Agency of USDA. Now, Risk Management Agency is the same folks that run our traditional crop insurance program. So this is just one more product in the large RMA portfolio. It was developed for the purpose of insuring both grazing lands and haying lands. So we've got a lot of pasture ground in Kansas, as we'll see. So it's a type of insurance that will cover production there. It's also good for covering our established acreage of perennial hay crops. So that would fit our alfalfa. And eastern Kansas, we have a lot of grass meadows that are cut for hay. All of those would be eligible for coverage under PRF. And RMA developed this product with the intention of having insurance that will supply some money for buying replacement feed in our bad drought years. We've all heard stories about the producers who've spent years building up their breeding herd and then had to cull a good portion of it when they had a bad year and just didn't have the money to feed them. So that's the purpose of this insurance, is so we can buy replacement feed in those bad years. PRF was actually started as a pilot program in 2007, and it's been available in Kansas since 2009. So it's been around a few years now. I wanted to spend a moment just talking about how much land is actually eligible for PRF in Kansas. You can see our map here that shows the different land uses in Kansas. Looking at the Census of Agriculture, it's over 15 million acres, it says, that's in permanent pasture in our state. And then it's got some other categories of pasture land too. And when we look at the hay side of things, yeah, we see we've got over 2 million acres in alfalfa and our other grasses that we can use to make hay. So adding it all up, it's about 18 million acres in Kansas that'd be eligible for PRF. Now, to put that in perspective, how does that compare to our cropland in the state? Well, when you add up our 4 biggest crops, that's wheat, grain, sorghum, corn, soybeans, we see last year that those acres planted in Kansas came to about 20 million acres. So my 18 million acre number there at the bottom for pasture and perennial forages, you can see how just important that is for the state of Kansas. I think another point that's interesting on this chart is when you look at the acres insured for our major crops, you see it's about 18 million acres. So about 90% of the acres for our 4 biggest crops are insured with one of the federal crop insurance coverages. When you look at what's insured on the grazing and haying lands, it's about 800,000. So that's less than 5%. So I think that's a good indicator of how new or still relatively new and relatively unfamiliar this insurance product is. So we have a long way to go before I think all our producers are educated and familiar with using it. So that's a little bit of an introduction. The background on PRF, it's sold by your private crop insurance agents, just like your regular crop insurance is. And also like federal crop insurance, the government pays a significant portion of the premium. You can see it's a little bit over half of it gets paid by the federal government. It uses $1 coverage per acre, and then it's based on a percentage loss. So we'll see how that works. We'll walk through the calculations later, but it uses $1 coverage per acre. I think you'll also find that it's designed with a lot of flexibility. It's intended to cover a wide variety of conditions. You've got this coverage available all over the country, so you're really talking about some big differences in growing season, forage type, and so on. And so there's a lot of flexibility. That also means it's a little more complex too. So we'll hopefully talk about all the angles as we go along. Another point there, that last bullet on the page, this is one way that PRF is different from traditional crop insurance. You do not have to insure all your eligible acres if you sign up for PRF. Now, on the crop insurance side, if you're insuring wheat in a county, you've got to insure all your wheat in the county. Well, that's not the case with our pasture and grazing lands and forage lands under PRF. You can insure one pasture, one field, whatever. You don't have to put the whole place in. That might be a good way to approach it for the folks who are trying to get familiar and learn more about the coverage as we go. Now we're talking about PRF. One thing that's really different about it is it uses what's called a rainfall index. In fact, sometimes you'll hear it called rainfall index insurance. And wanted to take a moment to explain what I mean by rainfall index. All we do when we're talking about an index is we're just expressing our actual precipitation figured as a percent of normal precipitation. And you can see the little formula there, and an example always helps. So we're going to be insuring different 2-month periods throughout the year. And as example, let's suppose our annual precipitation in that 2-month period is 6 inches. And suppose our normal is 6 inches and the actual is 4.5 inches. So what's our index? Well, we got 75% of normal precipitation, so our index is 75. All we're doing is putting our actual precipitation, expressing that as a percent of the normal, okay? So that's what the rainfall index means. So the way the insurance works then, if our actual rainfall index falls below the guaranteed level that we select for our coverage, then the insurance pays an indemnity, okay? And you can guarantee from as low as 70% of normal rainfall up to 90% of normal rainfall. So that's the rainfall index, and we all, you need to be thinking in these percent of normal terms. That's the way it's all set up. Probably want to say a word too about why we're insuring precipitation. You know, why are we worried about rainfall in the first place for our insurance? And the problem is our forage production for pastures especially, we don't usually measure our output. Now, if you think back on the crop insurance side, our crop yields are a key component of our crop insurance coverage. But if we're not measuring our forage output, how can we base the insurance on it? We can't. So what RMA came up with was we're going to use another measure that approximates our forage production. So this other measure, it's a proxy. And you see two terms there at the bottom, meaningful and measurable. Meaningful just in the sense of we hope that it closely mirrors our actual forage production. So when forage production is high, that means our proxy is also high, and vice versa. The measurable part is it's something that is straightforward, easy to measure. People understand what it means. And in the case of our rainfall, we're even going to have some official values that we'll be using. And when I say official values, the rainfall that we use for the insurance is based on our official government weather stations. NOAA is the National Oceanic and Atmospheric Administration, and they have one of their offices called the Climate Prediction Center, and they've got the official government weather stations scattered all across the country. So there's quite a few of them, and those are the rainfall reporting stations that are actually used for the insurance. Now, the way it's going to work is the insurance uses the 4 closest reporting stations to your location, and your location is actually defined as a grid area. We'll look at the map of how that works in a minute. But the insurance uses the 4 closest reporting stations to your grid area. It doesn't just rely on one station. We all know kind of the hit or miss qualities of rainfall, how it can be raining in one spot and just a few miles away be dry as a bone. And so using the 4 closest stations is an attempt to avoid that hit or miss kind of phenomenon. So NOAA actually does all these calculations already for the grids, and that's part of their reporting and analysis. So the insurance just takes advantage of what NOAA is already producing there. People ask me where the weather stations are, and this is the best I can come up with. These grids are show the density or the number of reporting stations within each of these grids. They're about ½ degree longitude by ½ degree latitude. So Kansas, we're doing a little bit better in terms of station density than some of our other western states. You look out in Utah, you have to go quite a ways to find the closest station, but we've looked in Kansas, and statistically we haven't seen a big problem of not having enough stations that are very close. We've looked at some production at station University Ranch in Hays, Kansas, a couple of university ranches in Nebraska, and we find that we don't see a lot of a gap between what happens in the grid and what happened at those particular ranches. So anyway, that's where the stations, how dense they are, and that's about as much as we can say on the station location at this point. We were talking about a grid, and this is what the grid looks like. I'm showing an example, not just in this slide, but for our other slides coming up, for a location where I'm giving a PRF talk in a couple weeks, and that's down in Medicine Lodge in Barber County in south central Kansas. So we'll show the grids and the decision tool example, all the online tools. We'll use the Medicine Lodge example here. But you can see the grid, and those grids measure a 1/4 degree longitude by a 1/4 degree latitude. And when you try to figure it out, it's about 17 miles north to south and 13 or 14 miles east to west. So that's about how big the grids are. You notice the lines too. If your farm or ranch happens to straddle a grid line, in other words, you got ground in more than one grid, well, you can insure it all in one or all in the other, or you can split it out and insure them separately in the two different grids. The point is, we're using our insurance. Our insurance relies on these grid areas, and there's only going to be one composite rainfall value for the entire area covered by the grid. Okay, so it's an area-based coverage, uses the 4 closest stations to your grid, and that's what how the insurance works. So you're wondering about how do they come up with the index? Well, they take these precipitation amounts at the 4 stations closest to the center point of your grid. And the way they calculate that is the stations that are closest get the biggest weight when they figure the composite number. So in our little drawing here, station 1 is going to get the biggest weight, station 4 will get the smallest weight. But everybody in the grid will be counted as having that same weighted number using results from all 4 stations. Okay, some other coverage features that we're talking about. I think we've mentioned the guarantees can go from 70% to 90% of normal. Remember that we are only insuring one peril here. It's only insuring against low precipitation. There are a lot of other factors that affect our forage yields, and they're not insured. You can see my little list there. You may think of other ones too, but all we're doing here is insuring against the low precipitation. Some more background on PRF. The policy follows the calendar year. So starts in January, finishes in December, and then when you're picking your coverage, you have to pick which parts of the year you want to insure. And the year is divided into 2-month intervals, and you have to pick at least 2 of those 2-month intervals to insure. And when I say there's no overlap, that means you can't pick something like May, June, and June, July. You can't have intervals that contain the same month. So you'll be insuring at least 4 months worth of the year. Now, once you pick your time intervals, then you have to allocate your dollars of coverage across the periods that you've insured. The most you can put in one period is 60% of your dollar coverage, and the minimum is 10%. And you get a chance to play around with that on the decision tool, the decision support tool we'll see later. But that's one of the challenging decisions to make in this insurance product. So here's where we're at so far. Producers have to identify whether they're haying or grazing and their location. They have to pick their guarantee level. They have to pick their dollars of protection. And this productivity factor is the factor we'll see that lets us scale up or down. We'll have a base value dollars of protection per acre, and then our productivity factor lets us adjust that up or down. We have to pick those time periods that we want to insure, and then we have to allocate our coverage among those time periods. And we'll walk through some examples to show how all that works. Before we go on to that, though, I wanted to mention, just as a brief sidebar here, there is another rainfall index insurance product out there that's available for annual forages. PRF is for your perennial forages, your grazing lands, and your perennial hay crops. But if you have some annual forages, so that could be your forage sorghums, your Sudan grass, triticale, oats for hay, anything that you're going to graze, hay, make silage out of, anything that's going to produce silage feed that's an annual, or livestock feed, that's an annual, from an annual crop, you can get this rainfall index coverage for it too. It has 4 different coverage periods during the year, and it's all based on planting date. But the rest of the coverage uses the same grid areas, the same rainfall index values, all the other machinery that goes into PRF is used by this annual forage index coverage too. So if you're interested in covering your annual forage crops too, that there's a product available for that. So just wanted to mention that while we're talking about the types of coverage. For people who are like to get online and look up this information, we've provided these 2 different websites here. The top one is the RMA web page that's devoted to PRF. We'll look at that in a moment, but we'll find all kinds of documents there. All the background that I'm providing today, you can go in there and find a lot more detail and read up and get the background on it. The second website that you really need to check out is this decision support tool. You can see the long address there. That's going to let us get online, look up our grid, and compare the different coverage options. So we're going to look at all of those. Here's the PRF page at RMA. You can see you can look at the policy language there at the bottom. It has some documents that talk about the rainfall technology, questions and answers, got a basic fact sheet. A lot of information there. You can go into a lot more detail after we're done with our program today, but spend some time looking at that. Now you'll see at the bottom there's a link that's highlighted. That's the link to this other page we really need to look at, our decision support tool. So if you clicked on that link, you come up with a page that looks like this. And I've circled at the top in red 4 different tabs that you'll use. The first one is your grid locator. I think you can see, with my pointer, you type in your location and it will zoom into your grid. Look it up for you. That's the grid locator page. It's got the historical indices for each grid. That's the next tab you see at the top, historical indices. Those are the rainfall index values going all the way back to 1948. So it really lets you, if you're inclined, to get in there and crunch the numbers and see how the insurance would have performed. And that's what this last tab also lets you do, estimated indemnity. So on the decision support tool that we'll look at in some detail, you'll be able to pick a different particular type of coverage, and the estimated indemnity tabs would tell you how that coverage would have paid out in every year going back to 1948. So a lot of data there you can check out and see how it works. The decision tool tab, that's where we'll spend most of our time. Again, you get to pick the different types of coverage, choose the time periods you want, coverage levels, and that's what we're going to look at in a minute here. I've circled this other item down here at the bottom, the grid ID number. There's a 5-digit number. Most of our crop insurance, traditional crop insurance, is based on a county type level, but our PRF coverage is all based on the grid number. So All the rainfall index values, all the premiums, the histories, everything is tied to your grid number. So it's going to be a key. Remember your 5-digit grid number as you go through all the other RMA supporting tools. Okay. Okay, so now we're going to spend a few minutes looking at the decision support tool, and mainly we're going to look at how you can compare the different index intervals, allocations, guarantee levels, and it'll also show you the premium costs. It also has a feature, it'll let you look at how your PRF coverage that you selected would have performed in a particular year. And we'll show an example for 1,000 acres of pasture. Okay, so this is the what the decision tool looks like, and that's pretty small. I know might be kind of hard to see, but you'll notice it has location information in the top. It's got the protection information on the top left, policy information, and then the main part of the screen is the protection table. We'll be looking through each one of these. The protection information part of the screen, that's where you get to select whether you're doing haying or grazing. You get to select your coverage level, and that's the 70% to 90%. You get to select your productivity factor. That adjusts your dollars per acre coverage up or down. You see you have a range of that you can adjust it there. And the insurable interest just says, well, is this full ownership for me? Or do I have a share with a landlord or another partner? You can sort it out that way too. Now here's the policy information. Several important numbers here. The number at the top, that county base value, that's the base value of dollars per acre for production, and that's the number that's set by RMA. Okay, that's based on their historic reading of rental rates and grazing values and all the rest. And so that's the base number that we start with. This next number, the dollar amount of protection, that's the number that we end up with for our coverage. That's the one we can scale up or down using the productivity factor. So you see the formula that I'm showing there. And in the earlier screen, I entered 150% productivity factor. I chose a 90% guarantee level. So that gives us $51.03 per acre. That's our dollar amount of protection. So that's how we calculate that number. The next one to look at is total policy protection. And all of that is just our $51 per acre times the number of acres that we're insuring here. So our 1,000 acre example, we've got about $51,000 of protection covered under the whole policy. Here's part of the protection table. You can see where we're selecting our index intervals. And those are the time periods that we want to insure. Again, we have to choose at least 2 of these, and you can see in our example, I picked just a very simple example. I put 60% in our May-June time period. I put 40% down in July-August. So this is a place where you select your time periods, and the tool lets you look at all kinds of examples. We'll talk a little bit more later about how you might decide which time periods to insure in your allocation. But this is the part on the decision tool where you make that entry. Okay, now this is the rest of the protection table. I'm sorry I'm walking through this in such detail, but I think it's important for you guys to understand where all the numbers come from. And it's not just a black box, it's spitting out numbers. This protection table, you'll see our number highlighted at the bottom, the $51,000 total protection. Now then we go up and we split that out using our allocation, our 60-40 allocation that we designated before. And when you make that split out, then you see that's where we get the dollars of coverage in each time period. Okay, so we put 60% in May, June. We put 40% in July, August. The rest of the table shows you how to calculate the premiums. This next column, premium rate per 100, you want to think about those rates sort of like a percent. So all you do is multiply your dollars of coverage times the percent rate there in the premium, the premium rate, and then that gives you the total premium. So in the May-June time period, it's a 15.26% premium rate. So that means our total premium is going to be $4,672. We can do the same thing in the July-August calculation. Now, this total premium column indicates the premium before we apply the subsidy. And that's what the last two columns are here. It breaks the total premium out into the premium subsidy, the part the government pays, and the producer premium, which, of course, the producer owes. In this case, we chose the 90% guarantee level, so the subsidy rate's 51%. The producer premium is 49% of the total premium. So our May-June premium's about $2,300. Excuse me, we calculate the premium for July-August, and we look down at the bottom. We've got about not quite $4,000 in total premium for the producer for 1,000 acres that are insured. So what does that come out to on a per acre basis? It's about $4 per acre. Okay, so we wanted to grind through these calculations just so people know where the numbers are coming from, and they can interpret that when they're using the decision tool themselves. Okay, the protection table also has this feature of letting you see how the insurance would have performed in a particular year. And so that's what this next slide is showing. We've got these two columns. I picked the example of 2012. That was a drought year that hit the state of Kansas pretty hard. And so we wanted to see how would PRF have performed for the grid that we picked and the coverage that we picked. Okay, so we've got our example. Our actual index value for this grid in 2012 for May and June was 57.6. So did we have a loss? Yeah, we guaranteed 90% of actual rainfall or normal rainfall, and our actual was only 57.6%. So yeah, we had a loss. Next question is how big of a loss? And that's the next thing we have to calculate here. It's called the payment factor, and it's just a percentage loss calculation. So we guaranteed 90%. Our actual was 57%. We take that difference, express it as a percent of the 90% coverage level. Turns out we had a 36% loss. Okay, so that's our payment factor. We had a 36% loss. And the final calculation is just multiply that protection factor times our dollars of coverage. So a 36% loss times our 30,618 coverage for that time period. Our indemnity is just over $11,000. So again, we're grinding through these numbers in painful detail, but I want to be sure everybody understands where the numbers are coming from and how they can make sense of the calculations. Okay, so we got an $11,000 indemnity in May, June. Do the same kind of calculation for July, August. It's about $7,800. We would have collected, had we had this coverage in 2012, we would have collected about $18,000, almost $19,000 if we'd had this insurance in place in 2012. So that's almost $19 an acre, and remember it costs us about $4 an acre to buy that coverage. So these are the kind of numbers and examples you can run with the decision tool. You can change the coverage features and try different months, different allocations, different coverage levels, and see how the coverage might have performed in this year or that. So that's the decision tool. Probably the most important thing you can practice when you get done, go home, get on the computer, and give it a try. Okay, so some other things need to mention, insuring haying lands. Now, the example we just looked at was a grazing example, but like I said, you can insure your alfalfa and your grass hay crops too. The main difference that you'll find is it's a much higher value of production per acre. So that dollar figure is going to be a lot higher number. But the rest of the machinery, the index intervals, the index values, all of that works the same as the grazing example that we just looked at. Another feature that you can get on your haying lands is you can insure both irrigated and non-irrigated hay crops. The non-irrigated hay crop, everything works just like we saw in the pasture example. For the irrigated hay crops, though, we're not insuring $1 per acre of forage production. We're insuring against higher cost of irrigation. So the coverage there is based on RMA's estimate of how much it'll cost to apply that extra water you need to get back up to normal production. So we're not going to spend any more time on that, but just remember the irrigated haying land, it works just a bit differently. Wanted to shift gears now and go to the second half of the presentation and talk about what we, I think, 3 different questions that the producers probably need to think over as they consider whether to buy PRF and what the coverage, which coverage they should pick. And the first question I list there is how accurately are the PRF rainfall index values? Are they going to accurately reflect the drought in my location? So basically that's asking, will PRF pay when I really have a loss? And so we'll spend some time on that. Second question is, which index intervals and coverage allocations should I be using? And what guarantee level, what dollar amounts? And then the last question is going to be, would PRF really provide, is it going to provide enough money to buy the replacement feed that I need in bad years? And so we'll take a brief look at each one of these questions as we go forward. Okay, so first question, does PRF really reflect my own forage and rainfall experience? The best way to do that would be to check that would be if you have a long detailed history of your own forage production. But again, especially on the pasture side, not many producers have that. So maybe we go to that second question there. How well do the PRF indices track with rainfall or track with drought in my county? And the way we're going to get at that is looking at drought years using the U.S. Drought Monitor. And I think most people are familiar with our drought monitor. We see the different classifications from D0 all the way to D4. And that's actually the categories used by our other forage program, the Livestock Forage Disaster Program. So we've had some exceptional drought in Kansas at different locations this year already. But looking at our example in Barber County, I took the drought monitor data and tried to pick out the bad years. The drought monitor data goes all the way back to 2000. So I looked at the number of weeks that were in the D2 column. That month's number of weeks were in the D3 designation and weeks in D4. And you can see the different years how they've sorted out here. Probably 2011 looks like our worst drought year. 2012 was also bad. It's interesting. In 2018, we're waterlogged right now in southwest, south central Kansas. But early in the season, we had some exceptional drought. So it shows up on our drought monitor number here. The point is we want to find some indicator of which years were the bad years. So if we know which years are the bad years, we can go to our decision tool and look up the index values for each time period during that year. And you see the simple little thing that I did. I put stars, the number of stars for how many bad years. 2011 and 12 were probably our worst years. Well, you can look at the index values during the growing season months for these periods, and at least for these 2 years, it looks like the index is doing a good job tracking our drought experience for that year. So this is just a way I think you can look up your index values for your own grid and at least have a starting point to say, okay, how well is this index going to perform for my grid when I have a bad year? So that's our example for Barber County. You'll need to do it for your own location. The second question about which intervals should I be using and how should I allocate my coverage? I think the first question we need to ask is, how does precipitation timing affect our pasture production? And one thing that varies across the state, I think it's an important question, is our pasture warm season or cool season? Our cool season greens up a little bit earlier. Moisture earlier in the season is going to be more important in that case. Precipitation, we also know it's affected by what's already in the soil at the start of the growing season. How well the plants were doing, was the pasture in good shape or pretty bad shape after last year too. All those things reflect the interaction between precipitation and our pasture growth. But we have a number of range science studies, the last bullet there on the page. All of it indicates, and our common sense tells us this too, that precipitation during the growing season is going to be the strongest predictor of forage output. The ranches we looked at Kansas and Nebraska, our May-June time period is the most important time period for those particular locations. And if we're coming at this insurance from a risk management perspective, well, we want insurance that pays when we have a loss. So putting more of our coverage in May, June, or whatever part of the growing season is most important for us is probably going to be a pretty good idea. Another factor that comes into the equation is, well, how much does cost vary from period to period? Which intervals have the lowest premiums? Well, the premium reflects both the frequency of loss and the severity of loss. And it turns out that the rainfall, at least when we measure it in percentage terms like our index does, it's the least variable in the warmer months. So these warmer months are not only important for forage growth, but it's also the period that has the lowest premiums. Now this chart shows the range of premiums if you look at all grids across Kansas and Nebraska. And we're just showing the range of premium values for that 90% guarantee level. So that's the highest guarantee level. And remember, in red there, our formula, the total premium is going to equal that percentage number, which is the rate, times the dollars coverage we have for that time period. So you can see which time intervals have the lowest rates. Well, it's going to be these growing season months that we were talking about earlier. If you look at the average for Kansas and Nebraska, it looks like May-June interval has the lowest rate there, coming in, maybe about 13%. And then January, February, and November and December are the intervals with the highest rates, the most expensive coverage. Now, this talk I'm giving in Medicine Lodge, the grid that we looked at earlier, that's where its rates for 90% coverage come in and compare to these larger groups. In general, in Nebraska and Kansas, the further west you go, the more variable it gets, and the higher the rates, and also the farther south you go, we tend to see rates get higher as we go that direction too. But this chart, it shows how much the rates vary from time period to time period. So we see there's actually quite a range. This chart shows a little bit of the same thing. I've showed the premium rates for the Medicine Lodge grid there. That top line is that 90% number that we looked at before. And then I show it for each of the other coverage levels all the way down to 70%. If you look at the May-June, for example, our premium rate's about 15% for 90% guarantee, and then the premium rate's about half that for the 70% coverage. So you can see how much premium rates also vary. Just wanted to show how they vary by coverage level too. Okay, and we also talked about probability of loss. Of course, the more probable the loss is, the more frequent the loss, the higher the rate's going to be. And so those this chart kind of mirrors what we saw in the last one. But I wanted to show in this also how frequently the losses can occur. If you look at the 90% coverage level, even in our May-June time period, we're still going to have a loss almost 45% of the time. And if you go up to the January-February time period, the 90% coverage is going to be paying out about 6 years in 10. So that's actually pretty frequent losses. Compared to the 70%, say we're in our early growing season months, the payout happens about just under 1 year in 4. So different frequencies of payout, and that, of course, that affects the premium too. The different strategies in terms of picking which intervals to choose and how to allocate the coverage, well, I came up with 3 different categories, strategies that I've heard people say. The first one is where I'm more inclined, cover the growing season. And so these guys are picking 2 or 3 intervals for that growing season period, the warmer months. It's most important for forage growth, and it's also the cheapest months to insure. But a second approach is what I call the cover your premium approach, or you could also call it maximize your chance of collecting approach. And we see more and more people doing this. Actually, the idea there is to put a little bit of coverage in every month. And so what you're doing, if there's any period of loss during the year, you're going to collect at least a little bit of indemnity. And this actually improves your chance of collecting and at least maybe covering your premium, getting your premium back. So that's a little bit different perspective on how to use insurance. And this last point, what I call big money, we're hardly talking about insurance at all anymore there. That's a few guys, they're just insuring those winter months that have the high chance of payout. And so they're not really approaching this as so much an insurance decision as rather improve my chance for a bigger payout. So don't recommend that one at all. But we do see a few people using that when we look at the data. Okay, last factor that I wanted to talk about as far as issues producers need to consider is, okay, this coverage that I selected, is it going to provide enough money to buy the feed that I need? So all I'm doing in this slide is just showing a simple set of calculations you might use to try to come up with that number. Okay, so I've started with that $18,000 insurance indemnity that we looked at from our decision tool slide a few minutes ago. So that was kind of a worst case year. Is $18,000 going to provide enough money to buy the feed that I need? So that's what we're asking. So you see this section down at the bottom, I said, say we start with $18,800 and hay price is whatever it happens to be. We can make a simple calculation to say how many tons of hay can I purchase. Okay, so that's a straightforward calculation. We can come up with if hay is costs us $150 a ton, for example, I know this $18,000 would have bought me about 125 tons. The next section then is to say, well, how many cows is that going to feed, and how many days will that last? So this section, I'm showing, we didn't say how many cows we're using in our example, but we did say we had 1,000 acres. So I've assumed a stocking rate, and so that gives me number of head of cows, and I assume a daily consumption rate, and these are big cows. I think they waste a little bit, so 30 pounds a day for 143 cows. Once I know those numbers and I know what consumption is per day, and once I figure that, then I can go ahead and figure, well, how many days will my hay purchase last? And again, you can work that out for different cases. So if you think 58 days in this example is way more hay than you need, then you might decide to go back and pick a lower coverage level, reduce your productivity factor, different guarantee, something that would maybe save you a little bit of money on your premium, and you'd still have enough money to buy the hay that you need. So just one perspective on is the insurance providing the coverage that we're hoping for. So just to wrap it up, kind of my long-term perspective on PRF in Kansas is every single grid that I've looked at across the state, and I've looked at a lot in Kansas and in Nebraska and Oklahoma too, in these widespread drought years, the index has done a good job providing protection. But we have to remember, though, because it's the grid system, because it's using these 4 stations, there's still the possibility that in a year when rainfall is a little more spotty, you could have one of those hit or miss experiences. But in the worst drought years, I think we've had a pretty good performance. The other thing that I would emphasize is the second point here. If you're in it for the long term, if you pick your coverage and look at your experience going back, say 20 years or more, and that's what I mean by long run, you're going to come out ahead because of the premium subsidy. In other words, the money that you're paying in premiums, you're going to get more than that back indemnities. And most of the grids that I've looked at get about $1.50 to $2 back for every dollar that you're paid in, if you're in for the long haul. And again, that's looking at a 20 to 30 year time horizon. So the premium subsidy gives us that advantage. So that's my long-term perspective on PRF. Just to wrap that up, I hope as our producers consider what their options might be, learn a little bit more about the coverage, get online and compare your rainfall experience with the historical indices. Try to figure out as best you can, is PRF really, does it do a good job protecting me in those bad years? Use the decision tool to look at all your different coverage options, which months you want to pick, how you want to allocate that coverage, and then do a little bit of pencil work. Will that coverage that I selected in a bad year, is it going to provide the money that I need to buy the replacement feed so I don't have to cull my cows? So hope everybody can walk through those questions when they're looking at their own case. Last point there is November 15th is our sales deadline. So if you're going to sign up for PRF for 2019, and again, remember the coverage starts in January. So if you're going to buy PRF, you have to see your crop insurance agent by November 15th. That's the sales deadline. So hope people have some time they can get online, look up their grid and compare some different coverage levels, options, and see how PRF might work for them as a risk management tool. That's what I have for today, and don't know if we will have some online questions or if we want to respond to questions in a later video. whatever works best.
If anyone has questions, go ahead and ask them.
Jeff has a question.
Yeah, sure. That was very interesting, Monty. I just wondered if you had any observations around the strategies that producers use. Particularly, you mentioned that the aim was to be able to buy in feed. Do you have any experience with whether people still sell off stock and just use the cash as income smoothing, or whether they do actually use it for feed?
The anecdotal evidence that I have is fairly limited, just in terms of personal stories. I know we have some good cases in northeast Kansas this year of producers. Second half of the summer was really dry. A lot of people had to make silage out of their corn. The pastures were dried up. And I know one of my contacts back there, he told me he bought the PRF, and it really saved the day for him this year. In terms of broader numbers, though, I think it's hard to say, but I think you see a little bit of evidence in the data showing producers who, instead of concentrating coverage in the growing season months, that they'll spread it out a little bit more over the year, which is kind of not your pure insurance decision rule. I'm pretty sure that they're using it for replacement feed if it turns out to be a bad year. But another criteria that they seem to have is sure would like to get that premium back. So we see a little bit of everything going on.
And my second one is, how would you explain the very limited take-up relative to crop insurance?
I think there's two factors. One is just the newness. It's still, the information is, the coverage is still fairly new, and a lot of producers have not even heard of PRF. So we're still working hard trying to get information out there. I think the second issue on slow uptake may be, I guess you could call it the complexity, because it uses this rainfall index, and what's that? And is the rainfall index for the grid really going to fit forage production for my farm? I think there's the hesitancy of knowing, is there a gap there? Is it real or not? I think our best research so far, at least for most of the state of Kansas, indicates the gap between PRF experience and my own local experience is not a big one. But that should not really deter most of our producers from considering it. But I think it takes a while for that message to get out, and we don't live in, they call Missouri the show me state, but I think Kansas, they want to be shown that too. So, they may want to talk to a neighbor and see how they did it before they jump in themselves.
Thank you.
All right, Anthony, I appreciate this, and I'm always available for the people who see this online later. I guess my email address is there and my phone number is there, so people can call if they have a question come up later, and do my best to answer it.
All right. Well, I just want to say thank you. Good information, and we will be posting this and another one with questions as well. So thank you for your time. Thanks everybody for joining us, and we'll conclude our webinar.
Thank you.
Thank you.